It's almost a default choice to go for a margin account, but I feel that there is a lot of misunderstandings and misconceptions about margin accounts. That's why in this video I wanted to cover what are margin accounts, what are the implications of them, and what are the risks also that you can have when using a margin account. And if at any point you find this video interesting or helpful and you actually learn something, please consider subscribing to my channel and liking this video. That's really the best support you can give me, and I'd really appreciate it. So the first question to answer right now is, what is a margin account? To boil it down to its simplest form, a margin account is about borrowing money. I'm sure you've already heard about a leverage, meaning that when you trade, you probably have heard already about having a certain amount of leverage. Well, that's exactly what it is. When using a margin account, you're using borrowed money so as to finance an investment that you want to make. And to be eligible for a margin account, and that's a federal law in the United States, you need to have at least $2,000 so as to be eligible for a margin account. But how does a margin account work? How does that borrowing of money actually work in real life when you're trying to place a trade? When you use a margin account, as I said, you have a leverage, meaning that you only require to put a certain percentage of an investment on the table so as to receive borrowed money. Let's take an example so it's clearer. Let's say that you want to buy 100 shares of a stock that is worth $100. If you want to buy 100 shares of a stock that is worth $100, your investment is worth $10,000. If you're using a cash account, meaning that you have to provide all of the funds that you want to invest, you need to put on the table $10,000. But if you're using a margin account, you only require to put a certain percentage of that investment, and the rest of the investment is being given to you. And if we take back our $10,000 investment, well, you only need to put $5,000 on the table, and the broker gives you the other $5,000 so as to complete the $10,000 investment. So you can see the benefit of doing it, because if the stock grows, let's say by, for example, $50, then the stock will have taken 50% in value, and your investment will also have taken 50% in value, equaling $15,000. And if you close your position, then you give back the $5,000 that you had previously borrowed, and you're left with $10,000, your first $5,000 that you put on the table, and $5,000 of profit because the stock grew by 50%. So when I paint this picture, it really looks awesome, because here we talked about gains, and you really have the opportunity to magnify your gains. And that's usually what is being advertised on brokers' website. They're going to tell you that you can magnify your gains, but also you need to be careful because you also can magnify your losses. And here I took the margin requirement of, for example, 50%. But note that depending on the product that you're trading, well, the margin requirements are going to differ from each other. I don't know about you, what you think about the example that we just talked about with the $10,000 investment, but I think that when you only have to put half of the investment on the table so as to be able to purchase the whole investment, well, I think it's already a pretty good deal, and it's already quite a big leverage. But you can go a lot further than this. Depending on the product that you trade, as I said, the margin requirements are going to differ. If you look at, for example, the TD Ameritrade website, and you look at the margin requirements for the futures for the crude oil, you see that it's only 6%, meaning that if you put $1,000, then you get $16,000 of buying power available to you. That's huge. And it goes even further than this. Forex is the product that is the most leveraged in this market, and you can even go up to 1 to 500 leverage, meaning that for every dollar you put on the table, you get $500 buying power. And that's huge, meaning that if you put $1,000 on the table, you get $500,000 available as a buying power. And people actually trade like this, and that's huge when you think about it. So when we talk about numbers like this, where you can get as much as 500 times more than what you put on the table so as to finance a possible investment, what are the risks that you can have when using a margin account? And honestly, you have huge risks when using a margin account. You really need to understand this, and I think that there is a big problem with communication, because as much as you can really find the risk by yourself if you just type on internet, I feel that a lot of people, especially with options, are just going into options without realizing the risk that they're actually taking when using the margin account. And the first risk that you need to understand is that you can lose more than what you have deposited in your trading account. And I know it's a big thing and it's very scary, but it's very true. But think about it. If we take back our example of the $10,000 investment, meaning that you want to buy 100 shares and each share costs $100, then the total total worth of the investment is $10,000. If you put the $5,000 on the table and the broker gives you another $5,000 so as to complete the investment, and suddenly let's imagine that there is a bad news, the stock goes to zero the next day. And don't think that it's not possible, because there are a lot of stocks that went out of business like this, and it's really possible. It's not like a crazy thing that never happens. A stock can literally fall to zero overnight. Well, if the stock falls to zero, then now your investment is worth $0, but you also lost the $5,000 that the broker had given to you for that trade. So now you're in a position where you actually owe money to the broker because you have lost the investment. And this is really a simplistic example of how you can go into a bad position and after that owe money. And I don't know if you were already aware about this risk that you can actually owe money to the broker, and I'm not sure that all of the options traders out there are actually aware about this. Please let me know in the comment section if you were already aware about this risk. And the second risk that you really need to be aware of when using a margin account is that the margin requirements can increase at any time regardless of what you say. And to understand this, let's take our example of the $10,000 worth investment, and as we said, you need to put $5,000 on the table, the broker gives you the other $5,000. Let's say that there is a very big fear that the market crash is happening, there already has been some down moves, a bit like what we're experiencing right now. Well, in that case, the broker, so as to protect himself, is going to tell you, wait, we're not giving you 50% of the investment anymore, we're only going to give you 30% of the investment, which means that for your $10,000 investment, $5,000 is not enough anymore. You need to put $7,000 on the table and the broker gives you $3,000, because now they increase the margin requirements and they force you to put more money into the trade, to be more involved into the trade, and they're withdrawing from the trade bit by bit because they don't want to risk their money. So you are the one becoming more and more involved in the trade. And usually the very bad thing is that when a margin requirement actually increases, it's usually when you're already in a drawdown, meaning that you're already in a losing position. So you have a double negative effect. You're already in a losing position, and on top of that, your margin requirements are increasing, meaning that you have to put more money on the table even though you're already tight because you're already in a losing position. So that's a very big thing to understand. And what I do personally is that even though the margin requirement when I enter the trade is 50%, I will set aside some cash in my account so as to be able to cover for potential increases of margin requirements. And the very bad risk is that if you're not able to actually meet the new margin requirements, well, you're now in a position that we call a margin call, meaning that your equity falls below the margin requirements and now you have to face some very bad decisions. Whether you close your position for a loss because your broker is forcing you to close it, or they close your position on your behalf. And that's a right that you give them when you sign up for a margin account. You give them the right to close your position regardless of what you say. And the worst thing is they have the right to choose which position they're going to close so as to meet the new margin requirement. So it's not even the position that you're in trouble with that could be closed by your broker. It could be any position of your portfolio as long as it's meeting the new margin requirements. So you see that you're giving a lot of rights to your broker when you're signing up for a margin account. You give them the right to close your position whenever there is a margin call, and on top of that, close any position of your portfolio when there is a margin call. And personally, when I started trading and using margin accounts, I had no idea about the risks that were involved, and I had no idea that, for example, the broker could close my position on my behalf, and I really had to research myself what were the possible downsides of a margin account. And I need to put a lot of balance here, because presented like this, margin accounts look like evil. As much as they can be very useful when you want to make an investment because they can allow you to buy more expensive products, there are really some real downsides and some real risks that you need to be aware about. And for me, the most threatening risk is the fact that margin requirements are going to vary. And because of this, the margin calls could be closer or further away from you. And if you're in a margin call, as I said, the broker can close your positions on your behalf, and any position. So you really need to be aware about this. And I don't know if you remember, several months ago, we heard about a Robinhood glitch that were allowing traders so as to have an infinite leverage. And this is the perfect example of why you absolutely need to understand what you're doing. Because maybe you heard about it on YouTube, on Reddit, there were plenty of Reddits about it. Basically, the traders that were using that glitch, that were premium Robinhood users and that were selling covered calls, allowed them to have a 1 to 500 leverage. And yes, I know that for every dollar that they were putting on the table, they were being given $500. And to give you the scale of the glitch, when traders were putting just $1,000 on the table, they were being given the access to 500,000 worth of leverage. And you can imagine that people used it, absolutely. And that's why people started taking positions worth hundreds of thousands of dollars, if not millions. And there was one guy on the Graham-Stephan show that got interviewed and who actually took this type of positions, and he said it himself. He didn't know what were the implications of a margin account of leverage, and he didn't realize the risk that he was taking. And I don't know how this story settled in the end, if there are people that actually owe money to Robinhood, but legally speaking, they owe money to Robinhood. And I know that for this person in particular on the Graham-Stephan show, they just basically got blocked out of their Robinhood account, and in their shoes, I would definitely prefer to be blocked from a Robinhood account rather than owing hundreds of thousands of dollars to a broker. So you understand the risk now of a margin account, and please, when considering using a margin account, please remember what are the risks of using a margin account, and if you're already using a margin account, maybe consider not taking too many trades so as to have enough cash on the side in case of the margin requirements that could, for example, increase during a market crash. I hope this video brought you a bit of knowledge, and if you've been watching until then, I really thank you very much. I hope you enjoyed it, and please, if you liked it, consider subscribing to my channel and liking this video. That's really, as I said, the best support you can give me, and I'd really appreciate it. Please take informed and safe decisions. I wish you all the best, and I'll see you in the next video.